Again, thank you for joining us for the workshop, Managing the Ups and Downs of Home Buying and Owning. So today I want to just spend a couple minutes going over the agenda for today. The first part of this webinar will focus on the buying process, including preparing to purchase, financing your home, and finding that home. And then the second part is going to focus on what you can do if you find yourself dealing with an unexpected situation and feel you are or might begin to struggle to maintain your mortgage obligation. So this would include preparing for the emergency, budgeting in an emergency, and finding a solution. So I am joined by a couple of our colleagues here from GreenPath, two of our housing counselors, and I am going to have them introduce themselves. So if you don't mind, Carol Purdue, would you mind introducing yourself?
And I am a housing counselor here at GreenPath. I've been here for almost 14 years, working with clients on their housing concerns, and I'm happy to be speaking with you.
And Kayla?
Yes, I'm Kayla Knight. I've been here at GreenPath, I would say about 7 years now. And right now, a bulk of the work that I do is pre-purchase counseling, getting clients ready to buy their home.
Right. So Kayla, do you want to go ahead and take us off on preparing to purchase?
Yes, absolutely. So first we'll be going over here how to prepare to purchase to buy a home. So buying a home is one of the largest purchases you will probably ever make in your life, so we do recommend you prepare financially to make sure what you are buying will be affordable. The first step we go over is preparing to buy a home by reviewing your budget. So what we recommend is instead of creating a budget based on what you think that you should be spending, we recommend pulling things like your bank statements, credit card statements, or even pay stubs to determine what you are actually spending on a regular basis right now, especially when it comes to items that can fluctuate, like groceries or gasoline. The pay stubs we recommend you pull so you can create a budget based on what you actually receive and pay after taxes, insurance, or other deductions come out. We will be sending out to you a budgeting worksheet to make this process easier for you if you are just getting started. Once you know what you are actually spending and what you receive, you can create a budget to make any changes that you think will be necessary to reach your goal of purchasing this home. So for example, if you know that you are spending, say, $300 a month on dining out or entertainment expenses, now that you see that, you can cut it back to, say, $100 a month and use that other $200 to build your savings or pay down your debt balances. And if this process takes a few months for you to get used to, that is just fine. Most people do get paid biweekly, so if you've never budgeted before, you may want to start tracking your budget on a biweekly basis. And do not give up on budgeting and tracking your spending just because it's hard to start. Habits do take months to form, and budgeting is a new habit that you will have to get used to. Don't think that just because you spent more this week than you wanted to, that means that the rest of the month is a wash. There is never a wrong time to start budgeting, and you've never spent so much that you can't get back onto your budget that very next day. And although each budget is unique, here's a rough guideline of what makes up the average budget. So as you can see, housing generally makes up about 35% of the average overall budget. Now this includes your mortgage payment, which is your principal, your interest, your taxes, and your insurance. It also includes HOA fees, as well as just utilities and general maintenance on the home. If your housing expense exceeds 35% of your income, you may need to decrease your expenses in other categories. So if you have, for example, no other debt, you can allocate more of your income to housing each month. Or if you decrease some of your other expenses like entertainment or transportation, you may be able to allocate more of your money then to housing. And if your housing takes up, of course, less than 35% of your income, that's great. That allows you to put more money into savings. The down payment is usually what most people think of when it comes to savings required to purchase a home. Right now, down payments can be as low as 3 to 3.5%. You do not have to bring a full 20% down any longer to buy a house. A lower down payment can mean a higher monthly mortgage payment because you have to then borrow more to borrow that same amount or to buy the same house, but the difference between your payments may be smaller than you think. Do not be afraid to contact a lender if you think you'll be putting less than a 10% down payment on a home even. There are loan products to help you meet your goal of purchasing that home. You can also use gifts to cover the down payment as well. If you have a parent who's interested in gifting a home, just remember that if you do use a gift to purchase the home, your lender may have that gifter sign a gift letter stating that the family member does not expect that money back. And if even you are using a gift, it's still a good idea to be saving money on a regular basis. Next, closing costs. This is a sneaky expense to purchasing a home. Closing costs usually make up about 2 to 5% of that loan amount. So if you only focus on the down payment, you want to make sure you've got something left over to cover those remaining costs. Sometimes as you go through the purchase process, you may have the opportunity to negotiate for a seller to cover a portion of your closing costs, especially if there are repairs that are needed to be done on the home. But we don't recommend going into the purchase process assuming that this will happen. You still want to make sure you have something set aside for those costs. Generally, we also recommend you have about 3 months worth of living expenses set aside in an emergency fund, just in case there's ever a loss of income and it takes you time to get back to work. During the home purchase process, a lot of people will turn to their emergency savings to cover the cost of the down payment or the closing. And that's fine if you use that savings, that's what it's there for. But we do still recommend you have something left over after the closing of the home, just in case you have an appliance that immediately breaks down. And then lastly, you do want to remember moving expenses and appliances. It's not uncommon to have to hire a moving van to trek all your things from one location to another. And this may only cost you, say, $100 or so, but it's still something you'll have to have on hand so you're ready to go after that closing. And also remember that there are often appliances that don't come with the home purchase. I frequently see people not have a washer or dryer included in the home purchase. So don't forget that you may want those appliances and have something to pay for them unless you are prepared to go to the laundromat on your own for the first month or so. Next, home updates. A lot of people go into a home knowing that there are things that they want to do right off the bat to fix the home. If you don't have anything in savings prepared for that, it could lead you to opening up things like credit cards and loans. And if you're not prepared for that monthly budget or that monthly payment, it could throw your budget a little bit out of whack. So don't forget that there are probably things you're going to want to change about the home as soon as you walk in. Next, when it comes to preparing the purchasing the home, we recommend you review your credit. There are 3 main bureaus that collect your information and generate credit reports, and they are Experian, Equifax, and TransUnion. When it comes to applying for credit, different financial institutions may review different reports. So in some cases, when applying for a mortgage, though, the lender may review all 3 of your credit reports. So we do recommend that you review your credit report from all 3 of those major bureaus at least 1 time per year. And don't be surprised if the information varies slightly from bureau to bureau, as some creditors may only report to 1 or 2 of those 3 bureaus and at different times throughout the month. The place where we recommend you get your credit report is annualcreditreport.com. It was set up by the credit bureaus in conjunction with the federal government for this purpose. When you go to this website, you should see that logo, that annualcreditreport.com, on the upper left-hand corner of your screen. We do recommend typing in the full website name, as there are a lot of imposter sites. And I personally recommend doing a soft pull of your credit report on something like a desktop or a laptop so you can save that report and get back into it easier, which is much harder to do on something like a smartphone. There's also a form you can use if you prefer to request your credit report by mail. It can be found online at annualcreditreport.com, or you can call this phone number to request a copy. which is 877-322-8228. Now that you have got your report, we recommend reviewing it for any negative or derogatory items. So we are a certified credit counseling agency as well as a HUD-approved housing agency. And if you're not sure what you're looking at, you can always contact an agency like us so we can go over what you're seeing. And the good thing about credit is that if you have had issues in the past, these issues do not follow you forever. You always have the ability to improve your credit score as time goes on. One of the red flags that you may want to tackle when you review this report are things like collection accounts. They can have a negative impact on your credit score. And if you see that you have any collection accounts that are valid, now is probably a good time to start making payment arrangements so that collection bill doesn't prevent you from moving forward with the purchase after you've already found a home that you love. Next, credit card debt. If you have balances that cannot be paid off in full in a month or two, that can impact your credit score as well as your debt to income ratio. So if you have the ability to start making higher payments on those cards to get the balances down, I highly recommend doing so. And do not forget student loans. A lot of people have not been paying on student loans for a very long time because of the federal forbearances, but there's still a good chance that your financial institution will have to find a payment, even if your payment says 0 on your credit report. So they may take a certain percentage of your student loan balance, like 0.5% or 1% of that total balance, or they will look at your old payment history to try to calculate a payment for your debt to income ratio. Next, if you find any inaccurate information on your credit report, you do have the right to file a dispute. We recommend starting by filing a dispute with the creditor or the collection agency that reported to the credit bureaus inaccurately. And if that does not resolve the issue, you can also file a dispute with the credit bureau directly that's reporting that incorrect information. We highly recommend you include any documents that can support the fact that this information is wrong. And we would recommend giving them about 30 to 45 days to that credit bureau to complete that investigation. And if you are still unsatisfied with that outcome, you can also file a dispute with the Consumer Financial Protection Bureau. And that website is consumerfinance.gov/complaint. Next, we start the financing process. We recommend getting a pre-approval letter from your lender before reaching out to a real estate agent. And this way, if you find a home that you love, you can be ready to make an offer as quickly as possible on that home. And this letter helps your real estate agent search for homes that they know are already in your price range. If you have a relationship with a financial institution, you can always start right here. And it can make that process a little easier as they may already have information that they'll need from you, like bank statements, right at their fingertips. If you have a family member or a friend who recently purchased a home and work with someone they like, you can always ask them for a referral as well. And this pre-approval letter, this is a formal commitment from the lender to give you a loan up to a cent amount. The offer stands for a certain period of time, like 60 to 90 days. There may be a fee for this process, and you still have to meet those qualification requirements at the time of the purchase. Next, your lender may ask you for pay stubs, a recent W-2 form to prove your income. If you are self-employed, they may ask you to provide something like a profit and loss statement to show what your income is versus your expenses. And they may also ask you for proof of assets if you intend on dipping into anything like retirement to cover the down payment. They may also request bank statements as well to show that you have the cash on hand to cover the closing costs and for that down payment. Next, your lender will most likely do a pull of your credit report to get a list of your debt payments, like any car loans or large balance credit cards. And in certain circumstances, you may be required to provide a couple other documents as well. So for example, something like a gift letter. If you are a person who maybe gets income from Social Security, they may require something like a annual Social Security award letter. Next, debt to income ratios. So throughout this purchase process, you will probably hear a lot about qualifying ratios or debt to income ratios, DTI. These numbers are used by underwriters to determine if the potential mortgage amount will be affordable for you. If your current ratios are higher than the allowable maximums of your lender, you will either need to increase your income, decrease your debt load, or purchase a less expensive home. A front-end ratio is the comparison of your gross monthly income against your mortgage payments, which again includes your property taxes, your insurance, and even any HOA fees. These ratios do vary from lender to lender and the type of mortgage you apply for, but typically a front-end ratio can be between 28 to 31% of your gross monthly income. A back-end ratio, meanwhile, takes all of your debt payments, including your future mortgage payment, and compares it up against your income. So they'll add up all those monthly debt obligations like the car loans, credit cards, or student loans. And then keep in mind that these ratios are determined by what the bank will lend to you, but they don't take everything into account. So, for example, if you're a person who has to pay child support, tuition, if you're still going to school, that you will need to take into consideration as you're the one who's going to be making this mortgage payment. And if you have a back-end ratio of 36% or lower, that's usually what the lender is looking at, but some loan types will go higher than that. Next, you have, of course, different types of loans. A conventional loan is a mortgage that's not insured or guaranteed by the government. It's held by a commercial lender or a private investor. You also have government-backed loans. So FHA, USDA, and VA are forms of government-backed loans. The federal government has specific guidelines that your mortgage company will need to follow. They do also have their perks. So an FHA loan, for example, may allow for that low down payment, like 3.5% down, but it may require a home inspection that cannot be waived. Meanwhile, a USDA or a VA loan could allow you to put down 0%. And the lender who works with these types of loans will guide you through the requirements of those particular loan types. Next, just is this a good time to buy a home at all? So I'm sure we are all aware that interest rates have gone up a little bit since the historic lows that we saw during COVID, and it can make home buyers question whether or not they should even try to buy a home right now. But what we would say is that as interest rates go up, generally housing inventory goes up as well. And more housing inventory means that you may be able to start doing things like making lower offers. You may have the ability to negotiate for things like seller concessions that could lower the amount of cash that you have to bring up front. And higher interest rates can mean higher payments right now, but if you get into the home and keep your credit up, you may be able to refinance to a lower interest rate and payment in the future as well. And then, of course, you have the fun part, which is purchasing and finding that home. When it comes to finding a real estate agent, you can search online. One search resource is just realtor.com/agent connection. Again, if you know a family member or a friend who recently purchased their home as well, you can reach out to their referrals. When you search online for a real estate agent in your area, I know I personally focused on looking for someone who had experience looking for homes in the city that I wanted to live in, who had recently worked with clients who bought homes in my price range, as I thought that that person would have more experience with the styles of home that I specifically was looking for. Next, you do want to figure out where it is that you want to live and what are the needs or the wants that you want to come with this home. So if there's a certain size of home that works well for you or your family, if you plan on having children, do you have a certain number of bedrooms or bathrooms that will be needed, or a certain school district that you're trying to stay within? And some people love homeowners associations and some people hate them. And how is this going to impact the neighborhoods that you're looking in? This is something you'll want to consider when you're working with that real estate agent. Once you've found the home of your dreams, your real estate agent and mortgage company will then work together to guide you through the rest of this purchase process. Your real estate agent should write you an offer letter that they think is competitive. If the seller chooses to move forward with your offer, you are on your way to buying that home. You usually have about 7 days to get a home inspection done on the home to make sure that your home is in good condition. Even though some lenders will allow you to waive a home inspection, we here at GreenPath do generally recommend that you get one done, if only for your peace of mind. Your lender will then order an appraisal. This will be done to make sure that the home is worth what you are buying it for. If it comes in a little bit less, you may have the opportunity to negotiate for a lower purchase price, or they may have you sign a document saying, yes, you know that you're paying a little bit extra for this house. And you will have to find your home insurance, a policy that you want to be on this house. They will go over when you have to have that in place. And then essentially it's getting the closing done and getting those keys to the house and making this home your own. Now we've gone over the purchase process, I'm going to turn it over here to Carol to go over, once you've got this home, what you need to do if you experience a financial hardship or some kind of emergency.
Thank you so much, Kayla, for that. And once again, hello, everyone. I'm happy to be speaking with you this afternoon. So, like we just heard, buying a home can be one of the most exciting times in your life, and for most people, it is probably their biggest single investment. But now it's time to talk about the opposite end of the spectrum, and that is what happens if you hit a bump in the homeownership road. These bumps in life are inevitable, but how you handle them will make all the difference in successful home ownership. So we're going to talk first about the things you can do to prepare for an emergency, and then we'll cover the options to handle the situation when it occurs. So one of the keys is having some emergency funds on hand that can cover those unexpected expenses or even a temporary loss of income. And Kayla touched on that earlier when she talked about budgeting. One thing the pandemic has shown is how essential it is to start building savings as soon as possible. And so one thing that can help is automating the saving process. It makes it easier because the money's transferred before it can be spent on other expenses. So like we heard, the goal should be to put 10% of your income into savings every month. However, something is better than nothing. So if you can't save the 10%, determine what your budget can support and start there. Having access to 3 months of living expenses will set you up to handle an emergency. You want to make sure you can get access to the funds quickly, so don't rely on things like a 401k fund because that can take some time to be sent out to you. Now, keep in mind, some people may be fine with much less than 3 months' worth of living expenses. If you have a financial partner that can take on more of the responsibility, then a smaller savings may work for you. If you work in a field where you can quickly find a job if you get let go, you may be okay with less money in savings. So you want to be sure to assess your own situation to determine the amount that you should set as a goal. Now, in addition to setting aside an amount each payday, consider using raises, tax refunds, bonuses, things like that to boost your savings. Because that money is not already a part of your budget, it can be easier to set it aside into savings. And so this can help you build your 3-month emergency fund faster. Another thing you can do is reduce your other debt. That can be key to being ready for an unexpected event. So you may have heard of the snowball method to pay off credit card debt faster. And you can start with either the lowest account balance that you have or the highest interest rate account, and then add extra to that payment every month to pay down the balance faster. Make the minimum payment on all of your other accounts, and then once that debt is paid off, move that payment to the next one and snowball that amount you were paying onto the previous debt onto the new payment, and then continue to build your snowball until you have the balances paid off. Now, this option is only going to work if you avoid using the credit cards while you're getting them paid off. To keep your balances from growing too large in the first place, avoid charging non-essentials. So this would be things like eating out, clothing, or other impulse purchases. So instead, set a budget for those items and save up the cash. You want to use the credit cards only for true emergencies like a car repair or a medical issue. Plan ahead in your budget for things like holidays and vacations so you don't have to use the credit cards. Birthdays and anniversaries occur the same date every year, so set aside money each month in preparation. Or you can consider doing a low-cost activity like a picnic, a museum visit, or some other fun activity instead of buying a gift or an expensive dinner for these occasions. You can also explore a consolidation loan if you have several credit cards with high interest rates. So a consolidation loan can give you one monthly payment and interest rate, but these loans will only work if you stop using the credit card so you don't begin accumulating a balance again. A debt management plan through a certified nonprofit credit counseling agency can also help you consolidate your payments into one amount with lower interest rates. A debt management plan requires the accounts to be closed, so you will not be able to run up the balances again. And you can contact GreenPath to discuss all of these options further to see what would work best for you. Another thing that can help you to prepare for an emergency is having a home maintenance fund. So this fund is separate from your 3-month emergency fund. This is just for the maintenance. So you should be setting aside money every month to have a fund of about 1 to 3% of your home purchase price every year. Having this fund will help make sure you can get your home maintenance done on time so you won't incur a larger expense later on. There's a checklist offered by HUD that will help you create a maintenance schedule for your home. We'll provide you with the link in the chat and send it out via email with the recording. Another way to cover the cost of your maintenance is through warranties. So this could include a home warranty, it could be appliance warranties, or a program with your local utility company. Often the seller may offer to pay for a home warranty to sweeten the deal when you're negotiating buying your home, and then you can decide if you want to continue to pay for the warranty yourself after it expires. When you purchase new items, be sure to fill out the warranty information so you can contact the manufacturer with any concerns. Some manufacturer warranties only cover defects and not normal wear and tear on items. Now, we're going to talk about budgeting for a bit. So Kayla had already mentioned the importance of having a monthly budget. So as a homeowner, you want to make sure you have that budget so you can plan and track your expenses. If you don't already have one, now is the time to get started. Write down all of your spending, including things like your groceries, gasoline, child care. You want to make sure you're accounting for all of your expenses, not just the monthly bills. And this budget is important to help you determine what's essential, and then you can make adjustments in areas where you can. Now, when an emergency occurs, the first thing you want to do is to determine whether the event is a short-term or a long-term emergency. So short-term means the situation will be resolved in 3 months or less. This could be a home or car repair or a minor medical event. So these events don't last long, but they can still be costly to fix. If you need to make room in your budget for a short-term situation, look for expenses that can be canceled relatively quickly. Things like streaming services, gym or other monthly memberships like food delivery services or Kindle Unlimited. The monthly amounts for these items may seem small individually, but they can add up quickly. You can also see if you can skip a payment on a loan or a credit card. Some car finance companies may allow you to skip a payment and add it to the back of your loan. Credit cards may allow you to reduce or skip a couple of payments. And if you have student loans, the servicer may allow you to get on a forbearance for a few months so you don't have to make the payments. Keep in mind that any payments that are skipped will have to be made up at some point. Also, eliminate as much unnecessary spending as possible, especially things like eating out or other types of entertainment until your hardship is resolved. Now let's look at long-term emergencies. So these are the situations that are expected to last 3 to 6 months or longer. So this would include a more serious medical event that could require time off from work. It could be a temporary relocation due to something like a fire or a weather disaster, or a temporary layoff from work or temporary business closure if you're self-employed. Again, the first step is to review the budget to determine which expenses must continue to be paid during this time. So housing, utilities, food, insurance, medical needs like prescriptions are some of the things to consider as top priorities in a long-term emergency. Anything else, and this includes credit card payments, should be considered secondary expenses until the emergency is resolved. In a severe emergency, such as a complete loss of income or if the income is drastically reduced, you will have to consider if you'll be able to afford your current housing. So this could include situations like a divorce or separation, the death of an income earner in the household, or permanent disability. So like Kayla was saying earlier, housing costs normally should be about 35% of your monthly income. If housing is taking up a larger percentage of your income, then it can be very difficult to stay current. You can also look at liquidating assets, like if you have an extra vehicle, recreation equipment, jewelry, or collectibles. These are items that can be sold to raise cash. But be very careful about liquidating assets like investments or retirement accounts due to the possibility of tax consequences. You also want to apply for any assistance programs that are available, whether it's through federal, state, or local governments or private organizations in your area. Things like unemployment benefits, disability, food stamps, and Medicaid are commonly known government programs that can provide assistance. But you may be able to get other types of assistance through local entities like the Salvation Army, churches, or other community organizations. Now it's time to talk about solutions. You've ridden out the storm, and now it's time to figure out your next steps. After you've reviewed your budget, you've made all of the adjustments you can think of, or if your hardship is resolved but you need to get the mortgage back on track, it's time to look at solutions. Consider contacting a HUD-approved housing counseling agency for free help. It can be really scary to try and figure out what steps to take to save your home from foreclosure. And foreclosure refers to the loss of your home due to non-payment of the mortgage loan. The first thing a counselor may talk about is affordability. So if you suffered a loss of income, but now you're working or have income again, is it enough to afford your current housing situation? Did you have to take a pay cut or lose your overtime opportunities? Or you a two-income household, but now there's only one income in the family? These are factors that will affect the affordability of the home. Together, you and the housing counselor will review your situation and your options and try and help you set and meet the goals for your home. A housing counselor can work with you to help you create an action plan. So this is a step-by-step plan to help you move forward. The plan will include target dates that will show you when you need to complete your next steps, as well as measurable benchmarks. Your housing counselor may schedule follow-up meetings with you to check your progress. And you can always call your counselor and get advice if you're struggling to meet your goals. You also want to contact your mortgage company right away to discuss the situation. A housing counselor can help you with this as well. Now, in order for your mortgage company to better understand your situation, they may require you to complete a hardship application. And this application will usually include a form known as a Request for Mortgage Assistance, or RMA. In addition, they'll usually want other records from you, such as pay stubs and bank statements. It's very important that you provide all of the requested information and fill out the RMA correctly. So ask a housing counselor or your lender if you have questions. Failure to fill out the application completely or correctly is a big reason why mortgage assistance is delayed or even denied. After you submit your application, the mortgage company will review it and determine which available options will best meet your needs. One option they may consider for you is a loan modification. So a modification is a permanent change to the terms of your loan, such as the interest rate or the length of the loan. And it usually involves putting the missed payments at the end of the loan or recalculating the loan balance to include the missed payments. So because of this, a loan modification can take some time to approve. So follow up with your mortgage company during the review process, and if you're not approved, find out why and see if you can appeal or reapply. If you're having a temporary hardship, like an unpaid or reduced pay sick leave or a maternity leave, you may be approved for a forbearance. So like we heard earlier, this will temporarily reduce or stop your payments for a few months. You'll have to make up those payments, though, either with a lump sum amount, a repayment plan, or a modification. A repayment plan involves making a larger payment for about 6 to 12 months to make up the missed payments. And then once the plan is completed, your payment will go back to the regular amount, and then your loan will be current. However, if you've been on a forbearance for a long time, then a repayment plan may not be affordable because of the number of missed payments. So then in that case, a modification will be a better option. Now, sometimes there are no options to bring the loan current, or the available options are not affordable for you. In that case, you may have to look at leaving the home. If your home is worth more than what you owe on it, you have equity in the property, so consider selling the home to get that equity. Now, this is a tough decision, I understand, but it will allow you to have some cash to start over. You could pay off some debts and then have some money to help you find new housing. If you don't have any equity or you're severely delinquent, your lender may approve you for a short sale, and that means the lender will accept an amount less than what's owed on the loan from a buyer. The difference that you still owe would either be forgiven or it could be repaid over 5 to 10 years. A short sale has less of a negative impact on your credit than a foreclosure, and the lender may offer moving assistance money to reimburse you for some of your costs. If your home is in good condition, but you can't find a buyer, then the lender may allow you to sign the home over to them and then move out. So this option is called deed in lieu of foreclosure, and again, some moving assistance money may be available to you. So finally, we want to talk about any financial assistance that may be available. So there may be financial assistance for the mortgage available from your state, but the funds may only be available under specific circumstances, such as during a natural disaster like a hurricane or a national emergency like the COVID pandemic. The funds are usually available on a first-come, first-served basis, and when the funding is exhausted, there's no more assistance available unless the program receives additional funding. And the additional funds usually must be approved by federal or state legislation. A housing counselor is a great resource to help you find out more about these programs and whether you might qualify. And then lastly, other potential resources may be available through your city or county government. Contact your local community development agency or a housing development authority to find out if there are assistance programs available. Sometimes these programs have restrictions such as income, age, or other requirements in order to qualify for the funds. And again, a housing counselor is a great resource for finding out about these programs. And like I said before, it's always free to discuss options to manage a housing concern with a HUD-approved counseling agency. So thank you so much.
Great. Well, thank you, Carol and Kayla. We're so happy that you were able to provide this information. For those not familiar with GreenPath, we are a nonprofit organization that provides confidential financial assessments on a variety of topics, including credit report reviews. So if you're getting ready to purchase and you want somebody to review that with you, rent, mortgage, a home buyer education, student loan counseling, and then again, options for dealing with debt. So you can reach out to GreenPath at 844-218-6167, and we would be happy to connect with you to answer all of the questions that you may have. Also, if you are interested, if you'd like additional information, you can take advantage of GreenPath's free online financial education. And we have a course in there called Homebuying 101, as well as one on forbearance and other mortgage payment options available in the Learning Lab Plus. You could scan the QR code on your screen, or you can use this link that I'm going to also pop into the chat. There it goes. All right. So again, we are going to plan to stay on the line for a little bit. If you would like to give us a call, the phone number is on the screen, the 844-218-6167. And you also can check us out at my.greenpath.com. So if you have questions, if you haven't already put them in the chat, please do so. We'll get those questions answered. And we hopefully look forward to you on your journey to home ownership, or making sure that the home can remain as you want it to be. Thank you so much. Right, so let's go through and see what questions we have. Kayla and Carol will also refer to you on those. So somebody was asking, what is an example of a collection debt?
Oh, do you want me to answer this one?
Sure.
Yeah, so I mean, a collection debt is essentially any debt that has, I don't want to say it's been considered a bad